Thank you. Well, it's a great pleasure and privilege indeed to be here. And interestingly, in some rather different context, my very first acquaintance with economics and economic problems began when I was spending a sabbatical year in Cambridge in 1976, which I think is before this institute existed, but it was already, I think, being thought about to a certain extent. And I will touch on that later in the talk as I go through it. It was mainly through acquaintance with somebody who is a good deal older than me, unfortunately. Hands up anybody, those who know or knew Wynne Godley. Very interesting that you're sitting together. Who was a very, very interesting man. It was an interesting first introduction, furthermore, to economics, because he was quite skeptical about the amount of faith that was being put in the Treasury's annual predictions. He had himself, earlier in life, been a professional musician playing in a BBC orchestra, but he applied for the Covent Garden Opera Orchestra and didn't get the job, and decided maybe he wasn't going to make it as a musician, and he came to Cambridge and got interested in economics. And he felt that if he established a separate institute within Cambridge that had a big computer model of next year's of the economy in competition with the Treasury model, and his model consistently outperformed the Treasury model, maybe people would take more notice of him. So he came and did that. And because he himself was not very mathematical and not very computer oriented, he got Cripps's son, who's a very bright young character, to run the model, and they consistently, for several years, outperformed the Treasury predictions, and it was all brushed aside on the assertion that they'd just cooked up the dynamics of the model. And my part in that is having met Wynne because I was at King's, and started playing backgammon with him at lunchtime, where admittedly he had a great weakness. For those who like backgammon, one of the things that make it not a pure chance game is whether your judgment in accepting a double at a given stage in it. And Wynne was unable to resist accepting doubles. So the only time I've ever played for money, it was with Wynne, and sadly he died owing me £5. But I thought it would be helpful if I made a simplified version of his model and got an analytic approximation so that I could show anybody who was skeptical that these conclusions followed from these assumptions. And we did that, and we wrote that up in one of the many papers that are currently being brought out of archives and made more generally available. But that still made little impression on those who believed their views. And I will touch on that general theme in other contexts, but I thought it was only appropriate that I say a little bit about Wynne because he was such a lovely man. Okay, turning to what I'm actually going to do today now, I am going first of all to say a little bit. Oh, I thought there was a first one. Somehow the outline is misbehaving. I was going to say a little bit about early warning signs. Then I'm going to, are there any? But that'll be very brief. I'm going to talk about complex networks and their stability and some earlier work in other contexts, particularly ecology. Oh, and then I'm going to begin with the early warnings rather than go back to them. And then I'm going to talk about some of the work I've been doing with Nim Arinamapathy, whom many of you know already, and Sujit Kapadia, who as recently as Andrew Haldane in the Bank of England has moved onward and upward. Sujit is now the head of the systemic risk section. And interestingly, these two people that I've got involved with in the things we've been doing had been great friends as undergraduates in Cambridge, had lost track of each other's careers, and not the least of the many things that we subsequently did, brought them back together. And I'm going to end by talking a bit about tentative implications for better regulation. This is sort of recapitulating for you a very brief version of my own journey through the background of all of this. And one has to remember that until about 1800, the dynamics of investment communities would have been rather different in that banks were UK owner managed, and if they went belly up, then the people who had been taking too many risks also went belly up. That began to change over 100 years ago, 200 years ago, when with the best of intentions, many consequent changes and reforms, as it says here, have come to pass. The unintended consequence, I mean, the intention was always to make the system more secure, rather than simply relying on the fact that the people who owned the bank wouldn't want it to go bust. But now, when the banks do go bust, as we discover, the cost of that, by and large, are imposed on the taxpayer. And there have been many interesting examples over the years of ways in which banks can go bust, and we can have crises of the general kind that we are still trying to get fully out of, have prompted reforms, many of which have had unintended consequences. And one of the implications has been that it has tended to drive a wedge between the economic interests of managers and owners who could take the risks, confident in the fact that if it went bust, the taxpayer would pay. And at this point I pause for an advertisement. It's an advertisement for a book that's just been published by Oxford University Press, and it's the outcome of a year-long, last year, series of seminars that were put together by David Vines and Morris, whose first name I forget. David Vines, an economist, both of them economists at Oxford, and it is a book that aims, its title is the aim of it all, I've failed to make a note of the title, which was pretty stupid of me, but it is addressed to the question of how do you adequately, I'm being stupid, I am so sorry. I thought I'd finished with the first page. It's called Capital Failure, Rebuilding Trust in Financial Systems. And the people it brought together were a combination of economists, philosophers, and lawyers. I mean, one of the philosophers was the head of the British Academy, O'Neill. A couple of the people who were lawyers had been involved in the troubles with when Lloyd's had troubles. And I think it's an interesting thing, and it's a book that, while not really on the theme I'm going to now go on and talk about, I think is worth advertising. Underlying most of this, and why that particular book, by addressing not just the technicalities, but some of the more miasmic, sort of as it were, personality aspects, is, I think, very relevant to Adam Smith's rather misleadingly interpreted assertion that selfish motives are a good way to produce sensible outcomes. And that depends a hell of a lot, that statement. It can be true, but it really does depend quite a lot on exactly what are the nature of the structure that you're working within, because there can be times when selfish motives can produce outcomes that aren't very good for anybody. I had thought, when I got first involved with this, that economics was another branch of sort of science. I now have realized, as you all do, that that's not altogether true. And I had not I was unaware that the person, you know, when you have committees, people come and sit in the same seats every time, that the person who sat beside me every Tuesday afternoon recently on the House of Lords Economic Affairs Committee, I hadn't realized that Robert Skidelsky was the person who had written this wonderful biography of John Maynard Keynes. My wife happily was reading the book and acquainted me with his more authoritative version of the unkind thing I'm in the habit of saying, which is that economics is a form, not necessarily of it's basic, it's not necessarily post-Christian theology, but the mode of discourse is one that would be more familiar to Socrates than it would to a post-Enlightenment physicist. It consists largely of ideas, interesting ideas, thoughtful ideas, which then lead to dialogues and quarrels, and largely in verbal form. And the notion of testing the ideas deliberately against experiments is relatively hard to come by in my acquaintance. There are also some other tricky things than this, the last of the early warnings and worry things. Hedge funds do a lot of good things, but there are ways in which the very nature of it can lead to the misallocation of risk. As you all know much better than I do, the basic way hedge funds make their living is they take a small, almost a small sort of bank interest-y these days, sort of a fee for doing the work, but they also keep, however, 20% of the profits that they make from their skills. If, on the other hand, the profits turn out to be negative, then they don't take any of the losses. The investors take all the losses, and the only loss to the managers is the 2%. And that, again, does not encourage avoiding serious-looking risks. Because if you've got if you're looking at something that maybe is going to turn out great, but quite likely is going to turn out terrible, you might as well have a bash at it, because you're not going to lose much if it turns out terrible. And although people may have difficulty in getting an internal mechanism, I'm sure nobody does this deliberately, but it is a peculiarity that tends to leap out at you if you're not part of the system. So how did I get involved in all this in more detail? That is a series of accidents. I have one of the many excellent graduate students I've had is a person called George Sugihara. And George Sugihara and I did some things on chaos, and in particular we wrote a paper that showed normally you think of nonlinear equations that are in the chaotic domain, you just can't make predictions, because even though you know all the rules and everything's determined, the future elements in the sequence are so sensitive to the starting conditions that even though you know everything about the system, nothing random in it, a few iterates down the road, you're not going to be able to predict. George turned that around and observed that there is a way of making short-term predictions here. You can make yourself a great library of all the past things this system has done. Quadratic map or anything else. And now you look at what just happened and you look for the most similar part of that manifold, and that will give you a quite good guide to the next few iterates. And we published this paper in Nature, and to sort of dramatize it, the first big computer that was built, the MANIAC, built by von Neumann and Ulam in Princeton in whenever it was, quite some time ago, used as its random number generator literally what today we'd call the quadratic map. And if you test its random numbers, so-called, by any conventional test of random numbers, it says, yes, they're random numbers. Except we showed in the paper, you could predict the first roughly half dozen random numbers was pretty reliable. George then parlayed that into running Deutsche Bank Securities USA for about 5 years. He made tens of millions in bonuses for both the firm and himself, and then he decided he really preferred being in a university, and he went back to San Diego and went back to fisheries. But in a very prescient way, quite remarkably prescient, in 2002, before anything happened, the Federal Reserve Bank of New York and the National Academy of Sciences in the States realized that all the increasingly elaborate things that people were doing were all oriented to the sort of short term, but most particularly they were oriented to maximizing profits with minimum risk for individual organizations, and nobody was asking questions about what are the potential implications for the system as a whole. And the NAS put together this study, and it looked for people who might bring read across, people who read propagation of infectious diseases or things like that. And George was an absolute natural because he was someone who'd worked in the banking sector rather successfully for 5 years or so, but also had a background in the other subjects. And so that's how George was added, and various other people, and George got me involved, and that's how I first got interested in this. And the whole thing is summarized in this report from the NAS. One of the things that George introduced into the discussions, and one of the most interesting, he said, what does the US banking network look like? Would somebody give me the sort of diagram? What's the degree distribution of the connections and so on? And the answer was, oh, that's an interesting question. And so this is a very indicative, it's not an accurate depiction, but this is the result of a study carried out by, in this particular study, at George's suggestion, and it's a study of some 9,500 banks in the United States, 60 of which account for roughly half of all the money and transactions. And the thickness of the line, so very crudely it shows this depiction of the handful of banks that are disproportionate, have about half of all the assets, even though they're only 60 odd 9,000th of all the interactions. You want to know more than who's connected to whom. I mean, and my thought when all this happened at the beginning was to think of making a little oversimplified mathematical model of how the shocks would propagate in this system. And I'd decided by analogy with ecological systems, which I'm not going to dwell on too much, but in ecological systems, if you tell me the network, what I'm interested in, the nodes in the network are well defined, they're species. And the connections are between any pair of interacting things, either they're eating you or you're eating them, or maybe you're mutualistically combining to eat someone else, or maybe you have no connections at all. But the degree that if I just tell you here's this web and the average one is the average thing is interacted to so many, or I tell you a bit more and I tell you how many have a lot of partners, how many have medium number of partners, that still doesn't tell you the structure of the network. Knowing the degree distribution, you need to know more than that. You need to know who is connected to whom, and that goes back to work on HIV, because the earlier work on networks very often didn't pay much attention to who interacted with who. So merely saying that this proportion interacted with half a dozen others. The real issue is, do people tend to interact with other does a given node tend to interact with other nodes that are similar to itself or not? That is to say, or to turn it into a HIV sort of people and the population wanting to make more accurate predictions of the propagation of HIV in its early days, which is what Roy Anderson and I were doing this for, along with Shanetra Gupta. Is it that the very active people with lots of partners are by and large interacting with other people with lots of partners? That would be associative. Or is it the opposite extreme, that people with very many partners are sort of, as it were, predatory on people with one or two other partners, disassociative? And it is interesting, the way the epidemic was then predicted to unfold, and we were doing this round about this stage in it, is very sensitive to that. And interestingly, you get the fastest initial phase with associative interactions, but at the end of the day, the thing that's worst for the community as a whole is to have disassociative associations. That's the way that's going to maximize the impact of the thing. And there's that, interestingly and rather forbiddingly, is exactly what this is. This is a very disassociative set of interactions in the financial network. So it's, if you wanted to construct something so that if something goes wrong, you maximize the number of people affected, you don't have to do anything because we've got it. Now, I'm just going to allude briefly to the analogy with the thing that got me from originally being a quite respectable physicist to move into ecology. And it's an epiphenomenon of the Vietnam War, oddly enough, in the sense that, particularly in Australia, and I think equally so here, the Vietnam War, and particularly the protests against it, with which I freely admit, much associated with. I had very long hair in those days and so on, basically prompted more acute questioning of not just what we were doing wrong in Vietnam, but more generally of what we were doing wrong environmentally. It was the beginnings of movements that have grown and grown and still have a lot of going to do to achieve some of the things we need to achieve. And it prompted, at that time, my looking at ecology, and I discovered ecology is it's a very young subject. The word is only just 100 years old, and the oldest ecological society professionally in the world is the British Ecological Society, which celebrated its centenary this year. So it's a new subject, and it was only just beginning to acquire a theoretical base. And the leader in that, or the two leaders, were Ed Wilson at Harvard and Robert MacArthur at Princeton. And I was coming on sabbatical to the Cullum labs, the plasma physics labs, because I was still a physicist. But I was getting interested in this, and I read an ecology text that was summarizing things, and it explained how complex ecological systems, where there are lots of species and lots of interactions, are more robust, more able to handle disturbance simply by virtue of being more complicated. And I found this, on the basis of everyday life, extremely counterintuitive. And so I constructed a little sort of thought experiment. I said, suppose I have a community of N species, every one of which has internal mechanisms which would make it robust against disturbance. If it got too many people, it would tend to shrink next generation. If there were too few, it would tend to get bigger. Suppose I had that, and none of the species interacted with each other. So if I wanted a sort of stability matrix for the system, I'd have a diagonal. There'd be zeros everywhere in the matrix except down the diagonal, and down that diagonal every one of the species would have a stability characterizing return time to equilibrium, a sort of -1. And now I will go ahead and I will sprinkle in interactions at random. And I will let, on average, each species interact with little m other species with an average magnitude roughly alpha. And I was able then to show, with some help from Freeman Dyson, because the second half of the sabbatical I was in Princeton at the Institute, I was able to show that that system would remain stable, as it would be if there were no interactions, provided the interactions were not too strong and not too many. Or more specifically, what I needed was that little m times alpha squared's got to be less than 1. And then it's still going to be stable, but it will start shedding species if you make it, if it's too complicated. Real food webs, of course, aren't randomly connected. They're the winnowed products of evolution. And when the first, I mentioned at the moment, the first paper I wrote on this sort of finance thing was a paper with Andrew Haldane that we published in Nature. And I had written a rather turgid, I wrote an opening chunk about the analogy with ecosystems. But then I ended it with a rather turgid paragraph like the one I just offered. And Andy Haldane, who writes much better than I do, added a little short sentence which said it all much better. He said, ecosystems are survival of the fittest. The way things are going, banks are going to be survival of the fattest. What I did in ecology basically redefined the agenda of asking ecosystems that we see are non-random. How do they preserve that? And that is still an ongoing project. We've made some progress, but it probably is a sensible thing to try and understand better. And there's encouraged by facts like Jennifer Dunn and others have gone and looked back at Stephen Jay Gould's Burgess Shale, and you find there are, insofar as you can make indirect inferences as to the network structure of the interaction between those weird organisms, there are some things that are very similar to today, like predator-prey ratios. So finally, I come to what I'm supposed to be talking about. I went away then and I said, I'm going to make this little mathematical model of a banking system, but the nodes are going to be much more complicated than in ecology, because in ecology, as I just said, it's a species and it's either eating someone or they're eating it. But in banks, as I have done quite a few times in my life, I move in some other direction, I try not to learn too much about what everyone has said about this, because I think knowing too much about it initially can inhibit thinking outside the box. Conversely, once I've had some ideas, then I go and read the appropriate literature. And I get very irritated at some of the things that come out occasionally where people get into something new and they cite the literature but clearly have never read it. It's a phenomenon that happens not infrequently at the Santa Fe Institute. But I digress. I like the Santa Fe Institute, but I still digress. So I said, in this case, if you look at a model of the banking system, the nodes are going to be more complicated, and there's going to be, coming into the system are both deposits from outside, money from outside being deposited there on the high street, or money that's borrowed from within the banking system as a loan. And there are going to be two sorts of things going out: money going out in mortgages and other things to the outside world, and mortgages and money going out as your payment of previous borrowings. And having done that, had that idea, I then thought I should talk to someone more knowledgeable, and I talked to that gentleman there, who said to me, that's far too simple. you don't really, you don't want to embarrass yourself with that.
Oh, I just said it was far too simple.
And you were quite right. But then and you gave me, I think it was you who pointed me to the paper by Sujit, that you say, here's a paper from the Bank of England, you should read it. And this was the paper, and this was the model of a node in the banking thing. So I was very chuffed with that, because that is exactly what I'd set out to explore. And what it says, of course, is there are the things, here are the things that are coming in, here are the things that are going out, and it had better be that the liabilities you have are covered by, in total, the assets you have. So you've got coming in the deposits and the interbank borrowing, going out the interbank loans, the external assets, and then you've got to keep a capital reserve of some kind so that if something does go wrong, you can cover it. And if indeed you take a loss there, that cross-hatched bit, such that you, sorry, the net worth is over here, the capital reserve is over there. If you take a loss that exceeds the net worth or capital reserve, then you're in trouble, and you're going to go into receivership, and the difference between what you lost and what you could have liquid money you could pay, that amount is going to go as a loss in the first instance, shared among the banks you borrowed from. Thank you. Thank you. I should have looked round for that. So if this bit here, if this is lower than that, this amount here is going to be shared among these creditors, and of course it means that the shock they experience will be much diluted from the shock you experienced, because not only is it going to be smaller, but even the small that exists is going to be distributed among several. So that's only one of the observations that you have to think about. But you can then ask of that system, which is what I did, if I wanted the system to be as fragile as possible, which is not an aim I want, but it's a question worth answering, how would I design it? And basically, and just going through it very quickly, I said, let me ask of the assets that you have, are they all interbank loans, or are they all deposits from depositors? Is it all high street, or is it all casino, or is it some mixture? And I'm also going to ask, how much is the capital reserve? And suppose the capital reserve is such that if you do suffer a shock, it will wipe you out if you're in that region. But the interesting question is, that's the initial loss you'll take, but is that going to propagate and bring down another bank? And within this triangle here, it will indeed, it'll require a much bigger initial shock to bring it down, but it'll bring that down provided the magnitude of the shock is big enough. And that will then propagate. This is the second phase, and this is in a third phase. But the thing that I'd never heard of Glass-Steagall. That I became aware of it when I suggested to Mervyn King that we bring George Sugihara across from the States and get some other people that might be interesting to talk about these things one day. I had got to know Mervyn while I was the chief scientist. I had actually met him on the occasion first where the Economics and Social Research Council was appointing a new director, and the government put together a committee with 3 civil servants, myself as chief scientist, and a token economist, token social scientist. And we interviewed some people. The 3 civil servants all wanted one person, and I and the token social scientist wanted another person, and we succeeded. And I thought, this is an unusually wise and skilled civil servant, social scientist. We must have lunch, and we took to having lunch together. It was Mervyn King. So I said to Mervyn, let's put this together. And I had never heard of Glass-Steagall, but of course this little toy thing that I did is, in its own crude way, an illustration of Glass-Steagall. If you want to maximize your chance of a shock doing big damage, then you want a rough mixture of high street and casino. And Glass-Steagall in 1933 derived from that observation in an earlier time, and it's why it wasn't until Clinton did away with Glass-Steagall in around 1990, and of course we never had an analogue, but once he did, then things were likely to be worse off. We then went on to make this more complicated, and I won't go into it in detail, but I think the most interesting thing that, and this is something that explicitly was done much more by Nim and Sujit than by myself, but it did seem to me that much of what we needed to be talking about was not so much the actual losses that individuals had or had not suffered, but rather the effect on the system of people just worrying about things. And we thought, while it's admittedly probably going a bit too far to try and turn that into a mathematical model, let's try. And we defined then some measure of sort of confidence among the players in the financial system. And we said that this is going to be a mixture of the solvency health, as it were, of the system, and the liquidity health of the system. You know, the solvency, whether it was all pretty safe, and if it wasn't, whether it could cover the problems. We let the solvency be defined as being the solvency health, the value of all the assets at a given time in relation to an initial value of some time defined. And the liquidity health is the fraction of the interbank loans that are not withdrawn, that are still as they were when they were started. And then we looked at the health of individual banks, and we defined analogies of that for each individual bank. A sort of the thing that was the capital A of the system as a whole is now the value of the bank I's assets to the initial value, and little m, the subscript I, is the fraction of the loans that bank I can settle immediately with liquidity or short-term assets. So that AI is of an individual bank as the analogue of the system's capital A, and similarly for little m. And then we said, if you've got two banks interconnected with loans, if the product of the health of bank I and the health of bank J is less than 1 minus C, then there's a problem, and both banks shorten their lending periods. You can see if the confidence is very high, that won't happen. If you're 100% confident, it'll never happen. But on the other hand, once the confidence level falls, this becomes more and more probable. And if even worse, this is less not merely than 1 minus C, but 1 minus C, which is less than 1, squared, then both banks call in all their loans. So that's a crude way of characterizing ways in which you might interact. Simple confidence things could drive you into a system that makes an initial shock persist longer than it might be. And arguably we're still in a state like that. You can then put that into models of many banks, and one of the models that we have pursued is one where we have a system of big banks and small banks. I can never remember the details, and I'll very quickly remind myself. But basically, the difference between this is if you just have one bank go down, then if there's no hoarding, if the confidence effects aren't in the system, then it'll be hard, quite hard. You have to go to quite low values of capital reserves before a second bank might go down by virtue of the propagation of the shock caused here. But once you put in the hoarding effects, once the first bank has gone down, it's pretty easy and pretty soon for the whole system to be in trouble. Now, the thing I particularly like about this is purely accidental. At this point is when Nim was still in Princeton, and at Princeton there is a very distinguished economist that many of you will know and that I had hoped to meet indeed yesterday, but he wasn't able to come to a meeting that we were supposed to have at the LSE yesterday, called Shin, and he did this study. And the thing that's unusual about it is that it's a study with a combination of some very nice mathematics with some data. And what he is asking, the data is based on an analysis he did of data from trading in Morgan Stanley. Along here are quarterly change in assets in billions of dollars over that roughly 6 year, however many year problem, and up here are the quarterly changes in debt and equity, quarterly changes in debt and equity, with the red line being debt, the blue line being debt, and this being equity. And he makes the argument that the main problem in the system still, on the basis of this, is debt rather than equity. Well, we were then able to go back to the model I just explained about the effects of confidence and ask of it the same questions as Shin asked of this data set. We just put it into our model to see what would happen, and we were enormously encouraged that for the debt versus equity question, it gives essentially, not exactly, but essentially exactly what the data found. And my acquaintance with the stuff that insofar as I've read stuff, with the interplay between ideas and models and data, is that it's not that usual that you get this, and furthermore has the added virtue that we got the result that conformed to the data even though we didn't even know the experiment had been done. More generally, if we go back to the model as such, we can ask questions like, in relation to the capital reserve, this is now for a system of 100 banks, so for 100 banks, 8 big banks and 92 little banks. The big banks are 25 times bigger in the sense that they have 25 times the number of loans that a given small bank has. Of course, they both have the same number of assets, to make the model simple, but each bank asset is 25 times bigger, and then you look at this in relation to capital reserves and so on. And I think one of these axes is accidentally mislabeled, but they're basically, this is going from you've got a capital reserve of roughly 1%, or 0.1, going down to going up to bigger and bigger reserves. And here you've got something that is doing something similar, and along a line that you can't see there, they're the same. And then you can run the system and see what happens. And what happens is, if this should be round the other way, actually. This is labeled wrong. It should be round the other way. If the big bank's reserves are not big enough, not big enough, it means compared to being quite big compared to what you want for a little bank, then essentially the whole system comes down here, and basically it's very hard, once a big bank goes down, which it will if the capital reserves aren't pretty large, the system is heavily impacted, whereas if the big banks have reserves more like that, if you read this backwards, the system is more safe. And it really does underline a combination of confidence effects and the role of the big banks. And it is interesting in that context to remember that insofar as one of the major recommendations of the Vickers Commission was that big banks maintain relatively bigger capital reserves, whereas exactly the contrary is what happened in the run-up to the crash, where although the big banks were at the time being asked to perhaps take bigger reserves, they simply argued their reserves were bigger than the reserves of the smaller banks, and therefore they shouldn't be made smaller. Whereas, of course, the magnitude of the reserves is ridiculous. It's the magnitude of the reserves in relation to the size of the bank. And that still is, I'll come back to that in a moment. You can also see in this that if it turns out, if you look at it in more detail, different runs, if you start the problem by choosing a small bank and letting it run into problems, then the total effect on the system that will unfurl is by and large unlikely to have more effect, really significant worries, other than for the one big bank. But if the one bank that failed. But if a big index bank fails, it is roughly 50% likely that the whole system will come down, and thus really the emphasis should be on the big banks. I'm going to skip through this bunch of things, which is a paper with Joe Stiglitz. No, I won't. Joe Stiglitz and Batterston and myself and a couple other people have written a paper also trying to draw out some of the morals of this. So I'm beginning now the last part of the talk. It begins with this observation, which is, I think, I don't like reading things that are on the board because you can read faster than I can talk. But the observation here is part of the problem is there isn't a clear and open market. So in many ways, these things that were created, these derivatives, have some of the properties of a sort of gambling den in which you can you can make your bets without ever putting cash on the table, in a curious sense. And in some sense, you can make the bets without other people knowing what the bets are. And the net result of that, if you look into it in more detail, is to amplify both positive and negative consequences. And I'll leave you to read that one while I find out where I am. And we're in the first paragraph that it says, hence figure 1. This is figure 1. This is just a study of what actually happened over this decade for different banks, and it goes back to the early warning signs. You would have thought that somewhere around here, and I'll come back to this in more detail in a moment at the end, which is close, you would have thought people at this point were already getting worried, rather than waiting till they really had to get worried. And I find that, and I will elaborate that in a moment, but also rather distressing is the fact that these things are heading off in the wrong direction, it would seem. And I found it slightly disconcerting when Carney, the new director of the Bank of England, reassured the economics community, the House of Lords Economic Affairs Committee, that everything was okay because things were going up again. Basically, the pricing of these things was all a bit of a nonsense, but I'll go past that. And there's a very good paper by Caccioli et al. That's worth reading, where they had a caricature of markets that in effect predicted all of the things that have happened before they happened, and simply by taking off from the definition of the way these derivatives were notionally priced and pointing out that if it was a vague approximation to the reality, which it was, the consequence of doing this would indeed be running into a singularity. It's a beautiful paper. It's more complicated than the icing model, which is saying something, but it was very prescient and sadly not read. When I told Sujit that there were these people in Trieste, and he said, "Oh, that'll be Marsili." Well, why hadn't Marsili sent it to somebody? But there we are. I'll leave you to read that one. But that highlights two of the recommendations that having some difficulty getting agreed. What you would like is to try and ensure that these derivative sort of things are not underwritten, as it were, by government-insured entities, so that if you're going to do it, you just recognise you're taking risks. You're not going to recognise you can walk away from it. And this one, B, would, if that were done, at least there'd be better information about the volume of activity and the exposures that various sectors were open to. Again, both are more or less there in the Vickers Committee, and neither of them seem to be attracting the sort of action that would be good. But the simplest, my view is that the simplest thing you could be doing is just saying that you've got to hold bigger capital reserves, and the bigger the bank you are, the bigger the capital reserves you've got to hold. They should be assessed not absolutely, but relatively to the overall capitalization of the entity using them. And particularly the bigger banks should hold relatively bigger reserves, whereas in the run-up to the crash, the opposite was going on. And that's one of Andy Haldane's observations about another thing that we could relatively easily do, which is having difficulty being implemented. And this is just a background sketch of that. Here, the size of the balloons is the total volume that was involved, and how high up they are is how much leverage they had. So the UBS AG has the honour of having almost the biggest volume and the biggest leverage, and there are quite a few banks that have relatively smaller ones, but even then, I mean, HSBC didn't, while it's not nearly as big as the others, was still surprisingly large given the way it has run itself in the past. Having some sort of sense of what is going on that's clear and open is the biggest argument for central clearing of counterparties, and that's again something that is not being easily introduced but would address a lot of the issues that I've touched on. But most interesting of all, I think this must be about the second or third last slide, there is a wonderful article by Benjamin Friedman, no relative to the other Friedman, who, as many of you know, is a very distinguished economist at Harvard, in which he made an assessment, and he didn't explain exactly what this means, but he made an assessment of the total cost of running the US banking system. And I'm not quite sure what is meant by that, but I think it is salaries and buildings and stuff like that. And then he assessed the total cost of the US banking system in relation to US GDP at the time, to sort of normalize against inflation. And he thought 30 years ago, that ratio in relation to GDP was equal to roughly 30% of all profits earned in the US. Which is a rather, sorry, is roughly, beg pardon. It was roughly equal to 10% of all profits earned in the US. The cost of running the system 15 years ago, halfway to the present, had doubled to 20% of all profits earned in the US, and just before the crash it was up to 33%. And I haven't seen, I don't quite it'd be nice to have a more complete understanding of what he meant by cost of running the system, but I've not seen that picked up anywhere other than the very good article that Friedman wrote in the New York Review of Books about 3 months ago. And he ended with this statement, the conclusion it drove him to, that time has come, he said, to reconsider the industrial organization of banking, whose proper aim is the efficient allocation of capital in a free market system. You know, the invention of banking is what made the West triumph. And countries that were behind were still mired in less egalitarian systems, whereas Britain, by taking the lead, along with others, in inventing the banking system, meant that not people who hadn't great sums of inherited wealth, but had a great idea as a result of the advent of science and what flowed from it, were able to borrow and make money, and that drove the rise of the West. But these days it's a bit hard to see it as having as its primary aim the efficient allocation of capital in a free market system. And this is going back to the beginning and ending of the subject of early warning. I think this is an extremely dramatic slide done by Andrew Haldane. What he did is he assessed the total UK bank assets normalized against GDP beginning in 1880, and for a century that banking system worked, and that ratio was about 0.5. Then around 1970 it started to climb and climb and climb and climb. It's to me a matter of bemusement that at no stage on this it was around 8. It was around 4. It had increased by a factor between 8 and 10 compared to what it had been for a century earlier. What was driving it? I've not found anybody writing anything to explain what caused this, but I do have a suggestion. That's around the date when I carried out my PhD thesis in Sydney on the first mainframe computer that had been built in Australia, and around that time it left me, I may say, with an abiding intention, which I have managed to fulfill, of in future dealing with big computers via the medium of graduate students. And this is in the days where it was all paper tape, and it was really a pain in the neck, but that was the beginnings of faster and faster computers that gave us the ability to do all sorts of things that we couldn't have done before. You couldn't have created financial instruments of the complexity that caused the crash. You couldn't have done it without that computing power. I mean, many of the prospectuses of these things, as someone has estimated, if you were to take one of these complex derivatives and write it out as an old-fashioned booklet, many of them would run to 1,000 pages. So you needed the computers to come along and do it. That still doesn't explain how once it had taken off, it just went and went and went, and nobody really thought it was peculiar. And I think that's a good place to end. Those are some further reading which I'll lead on if there's time for some questions and people.
Are there any questions?
So just clarify, Bob, are you saying that not only are the detailed definitions of derivatives things that take 1,000 pages to write out, but also they're secret and the trading in them is secret anyway?
I'm
astonished to hear that. I didn't realize how many obvious perils there were in the system of that sort.
Well, that's my understanding. The word, any of the print words that you tend to see are things other people have said, but they're sort of respectable people. So I guess it's true.
It's like having a large inflammable building in which it is secret how many people are striking matches in how many places.
I thought your description of the gamble rang a bell. I've been working on valuing with my group complex derivatives for people suing the banks for the last 7 years. And you pointed out that it was a gamble on some kind of knowledge of forward market economy or whatever. However, you also did some work with Joe Stiglitz, and therefore asymmetric information is pretty important to this. It's a gamble which we've seen that the banks know, for example, in 2006-07, they knew there was going to be a crash. All the leading banks, but you know, while the music's playing, you've got to get up and dance, as we heard. And so it's a gamble which local authorities, businesses, high net worth individuals and so on really don't understand how the market is moving. And of course, not the whole system, but you design the derivative to take advantage of something that you're very sure of, foreign exchange rates or whatever, rates in general. And I've been struggling to estimate how much is being extracted from the global economy by this process. And my best guess from BIS statistics is something of the order of $3 trillion a year. That's, what's that? Well, it's a large proportion of the 60 trillion odd of global GDP.
£2 billion, roughly.
Yeah, exactly. £2 billion. A lot of money. £2 trillion, I should say.
Yes. Well, I don't know enough about firsthand about the regulatory system as to why it didn't work better, but you can see how the thing sort of gathered momentum, and there were people beginning, and even that it's easy to see how the difficulty in that even in retrospect some of the suggestions are being resisted.
Yeah.
And before you'd actually, we're not having to argue about this looks like it might be a bad idea and might cause problems. We're starting the point is this was a bad idea and we have got problems, and the problems were partly caused by this, that and the other thing, so here we can change this. It doesn't really get a warm reception.
Well, one of the things that came out from the previous workshops that we've had here, which I very much like your comments on, was, as you were saying earlier, when losses are propagated through the financial system because a bank defaults so it can't pay something, then those direct losses tend to be spread out and they kind of get attenuated by an interbank network. On the other hand, when losses are inflicted because of confidence and people worrying about the value of assets, and especially when you have mark-to-market accounting, then you've got an inherent amplifier, because it may be that 99% of the relevant assets are being held by banks that haven't failed, but if 1% of the relevant assets is held by a bank that has failed but then has to sell them off in a fast sale, or for some other reason people begin to question the value of those assets, that can then mean that a relatively small loss in one place can be amplified and then, of course, re-amplified. And I believe you've done some work or I know you've done some work in this area, and I wonder if you can elaborate on the difference between amplifiers and attenuators and how this impacts to the whole systemic risk issue.
Well, first of all, in the issue of attenuation, I said that about when it was being passed on just in back to borrowers. So you took a loss this big, but now you're trying to repay a whole set of people. So each of them are going to. You're not trying to. You're passing on your non-payment. So they're each taking a shock smaller. That would be if you didn't allow for the confidence effect, and that I wouldn't trust myself to sort of say what's the relative magnitude, but if I were really forced to, I would say I see the effects, the more, and I tend to use the word miasmic effects of confidence, the fact that there's something wrong, so we'd better just play it safe, to be probably more important than the actual thing, as you just said. It's harder to quantify, but there we are. And it, again, I'm repeating myself, what I find difficult is that most of the proposals, and some of them seem so straightforward and sensible, greater transparency, recognizing that big banks are disproportionately important and they will both spread bigger shocks, but more importantly, arguably, they will be more inclined to provoke worries. And so what do we do about that? It's not evident, and I may be just ignorant, but it's not evident to me that these things which you could be doing things about are not being done about them.
Well, they're trying, but there's been a lot of lobbying and pushback from the banks, I think some of which has been extraordinarily short-sighted.
But I think there's another reason, actually. I mean, and it's your diagram. If, in fact, the assets of the banking system is 8 times national GDP, sorry?
But it's 5.5.
Okay, 5.5, whatever. Yeah.
No.
I mean, the point is that the government then, especially in this country, which relies on this system, is very loath to do too much tinkering.
Actually, it is more like 8 because it was sort of like 4 compared to the first tick on the y-axis. But it was initially only halfway to the first tick on the axis, so it's twice the last number you read. That's how it got to be 8.
That was your label, was it?
It's a really big...
I would just like to comment on that graph, because that graph where you showed the ratio of banking assets to GDP, I mean, starting the 70s, especially after the advent of floating exchange rate markets, London became an international financial market. So a large proportion of those assets are actually not UK generated assets. So it's not like UK GDP is being invested in the banking sector. This is money flowing in from the whole world, China, India, Russia, as we know, a lot of investments that are taking place. So this should be seen as in the context of London becoming an international financial center. So that is a flow which is largely from outside the UK. Well, but the other point I wanted to make is with respect to the confidence issue. So there is a very interesting letter by a certain Mr. Cox, who was the chairman of the SEC, the US regulator. After the default of Bear Stearns, Cox wrote a letter to the Basel Committee, and this letter is online somewhere, you can find it. And the letter says, well, you know what, when Bear Stearns defaulted, they actually had excess capital on the day of their default. But they ran out of cash. So it was a liquidity issue. And 1 week before they defaulted, they actually had several billion in cash. So it was something which evaporated very quickly because the people who were lending to them suddenly stopped lending. So it is an issue of confidence, as you say. But if you look at this example, it's quite worrying because it says that if you look at these ratios, liquidity, capital, and so on, 1 week before this default happened, and it was very similar in the case of Lehman Brothers, the numbers were okay, they looked okay, but this is not a static network. And in the case of the liquidity reserves, they evaporated in a few days. So the confidence evaporated. And I think this is not something we don't understand how to model well, because even if you make sure the ratios are okay at time t, doesn't mean in a week or so they're still okay. And I think that's something that we really don't know how to model, because we can look at the network and say the numbers look good, but this is not a stationary system. And the contractual agreements in place, which make the numbers look good, are not infinite. I mean, they're not very long-lived. And I think that's a very difficult question, and that's what some of the regulators are trying to address. But it's really a difficult issue because we don't have this stationarity in time, and the models which we see, network models, they contain very, very, very good ideas, but I think they are still too much static. And we don't really understand how networks react under stress. And this is a kind of a very difficult question.
That's very, very thoughtful comment, and to me it simply underlines how difficult it is going to be, because given that something like big banks should hold bigger capital reserves is sort of transparent and straightforward and sensible, and yet that is being resisted. And if you can't get that done, then to do something as complicated as you just said needs to be done is very worrying. Sounds like really.
Just to link this a bit back to ecology. So at the network level, obviously one can draw parallels between these systems. But I'm wondering, based on what you were saying, whether at the level of nodes, the systems are very different. And in the sense of an ecological system, you have fitness, which is a very real property. Population sizes grow or shrink. Whereas perhaps in these cases, the nodes don't have that.
Yeah, the nodes don't have elasticity.
You were saying that the losses are never accounted for. And I wonder whether that's a key aspect, and whether you can comment on that, and whether we can make these systems more biological by changing what the nodes are.
That's a very thoughtful comment. I have to say, thought has never occurred to me. I tended to think of the things that I did in the purely ecological context was just addressing the conventional wisdom of the 60s, 70s, that a node was a node, and things that had lots of nodes were, it was a sort of not a very logical argument, but it was all framed in terms of having lots of things, that the connectivities were important. But it was thought that was the implicit assumption. I never really thought about it. That again is not a great comment. I just sort of accepted without thinking about it. The nodes were something that was there, and then you were interested in the connections and how the nature of the connectivity network was such that if you messed up one bit of it, how would it propagate? But you're pointing out as you do that you really need to recognize that the nodes will have forms of different magnitude and so on. It's an interesting question. It'd be worth pursuing. Very good, very interesting comment.
I think on that.
The two best questions I've had in all the talks I've given on this. Sort of bonus points for the Institute.
Well, I think we should continue this conversation over a glass of wine in the foyer. But before we thank Bob May again, let me remind you that the talk has been streamed live, and in a day or two you'll be able to watch the rerun of it on our videos of seminars, which is on the Institute's website, and you can recommend it to your colleagues and students and so on as well. So having said that, let's thank Bob again for a very interesting